Hello, and welcome back to Explain the Charts, your go-to channel for in-depth technical and fundamental analysis. Today is October 23rd, 2025, and we are breaking down the massive news and subsequent price action for Tesla, symbol Tesla. The big story is, of course, the Q3 earnings report that dropped after the market closed yesterday, and the market reaction has been swift and decisive. While Tesla reported record revenue of $28.1 billion, beating expectations, they missed on profit, with adjusted earnings per share coming in at 50 cents versus the 56 cents expected. The stock slid about 4% in after-hours trading as investors digested the news. Several factors contributed to the earnings miss, including a significant drop in regulatory credit revenue, a 50% surge in operating expenses due to AI and R&D spending, and a reported $400 million hit from U.S. tariffs. This has caused operating margins to narrow significantly, a key metric that investors are watching very closely. During the earnings call, Elon Musk focused heavily on future projects like the Cybercab robotaxi and Tesla Semi, which some analysts noted was more geared toward engineers than investors, perhaps contributing to the stock's slide as it overshadowed concerns about current demand and margins. Analyst sentiment is currently mixed, with some like Dan Ives of Wedbush maintaining a very bullish $600 price target, calling Tesla the most undervalued AI name. However, others like Jefferies have maintained a hold rating, and data from Stocktwits shows retail sentiment has flipped to extremely bearish. Another key event on the horizon is the annual shareholder meeting on November 6th, where a vote on Musk's controversial pay package will take place, adding another layer of uncertainty. So with that backdrop of mixed fundamentals and upcoming catalysts, let's dive into the charts to see what the price action is telling us. Looking at the daily chart, we can see the wild ride Tesla has been on over the past year. The stock saw a massive run-up into late 2024, peaking near $480 in December before a sharp correction took it all the way down to a support level around $220 in March of this year. From those March lows, we saw a very strong recovery and a clear uptrend that lasted for months, bringing the price right back to test highs around $470 in early October. This established a clear resistance zone that the stock has since pulled back from. Now, let's zoom in on the price action from the last few weeks leading up to this earnings report. As you can see, after pulling back from the highs near $470, the stock entered a period of consolidation, trading mostly sideways between $430 and $450. This tightening range often indicates that the market is waiting for a catalyst, which in this case was clearly the Q3 earnings. The candle for yesterday, October 22nd, closed down near $439, showing some weakness heading into the report. The real story, however, unfolds in the after-hours session, which we can see more clearly on the lower timeframes. Let's switch to the 15-minute chart for the last 2 days. Here we can see that sideways action we just discussed on the daily chart. But watch what happens right around 2000 hours Universal Time coordinated yesterday, which corresponds to the market close and the earnings release. We see this massive increase in volume and a sharp drop from the $443 level. The selling pressure continued through the after-hours session, with the price eventually bottoming out around the $421 level. This price action directly correlates with the news of the earnings miss and the market's concern over shrinking margins. This has created a significant price gap and a clear trend reversal on the short-term charts. Now, let's go back to the daily chart to map out the key levels we need to watch going forward. With this sharp downward move, the entire dynamic of the chart has changed. The previous support area between $430 and $440 has now become immediate resistance. For the bulls to regain any control, they need to reclaim this level and do so with significant volume. Above that, the major resistance remains the recent peak around $470. On the downside, the first area of support is the low from the after-hours session, right around $420. If that level fails to hold, the next logical support zone is the area of consolidation we saw back in September, roughly between $410 and $425. This $410 level is absolutely critical. A break below $410 would be very bearish and could open the door for a move down to the psychological $400 level and potentially even the August lows in the mid-$300s. The major long-term support remains that March low around $220, but that is a long way from here. So, what's the bullish and bearish case from here? The bullish case is that this post-earnings drop was an overreaction and that the long-term story around AI, robotics, and the cybercab remains intact. Bulls will want to see the price hold this critical $410 to $420 support zone and begin to form a base. A strong bounce from this area, perhaps fueled by positive news leading up to the November 6th meeting, could present a buying opportunity with a target of reclaiming the $440 resistance. The bearish case is that the fundamentals have genuinely deteriorated. Slowing growth and margin compression are serious concerns that can't be ignored. Bears will be watching for a failure to bounce and a decisive break below $410. If that happens, it would confirm that sellers are in control and the path of least resistance would be lower. The extremely bearish retail sentiment suggests many are positioned for this outcome. Long-term, the story depends on whether you believe Tesla is a high-growth tech and AI company or a car manufacturer facing increasing competition and cyclical headwinds. So to recap, let's outline the key takeaways and predictions. The most important price levels to watch are resistance at $440 and support at $410. The price action around these two levels in the coming days will be extremely telling. Here are a few potential scenarios. First, a bearish continuation, which I see as having about a 60% probability. In this scenario, the stock fails to mount a significant bounce, breaks below the $410 support, and begins to search for a new, lower range, possibly between $350 and $400. This would be reinforced if the broader market shows weakness or if more negative sentiment surrounds Tesla's margins. Second, a range-bound consolidation with about a 30% probability. Here, the stock finds its footing in the $410 to $420 zone and chops sideways between there and the $440 resistance as the market awaits the next catalyst, which is likely the November 6th shareholder meeting. And third, a bullish reversal, which I'd give a 10% chance in the immediate short term. This would require a very strong catalyst to quickly erase the post-earnings losses and reclaim $440, invalidating the current bearish sentiment. Keep a close eye on trading volume. A break of key levels on high volume adds conviction to the move. Also, pay close attention to any news related to the shareholder vote or production updates, as they could easily shift the narrative. Thank you for watching this analysis on Tesla. Please remember, this is not financial advice and is for educational purposes only. Always do your own research and make investment decisions based on your own risk tolerance. If you found this video helpful, please hit the like button, subscribe to Explain the Charts, and ring the bell so you don't miss our next update.